Thank you, Dr.
I'm going to unmutify, and I'm going to sherificate my screen. Let's see. All right, so sideways volatile. I'm going to talk more about. I'm going to be your general contractor on this one. All right, I'm the carpenter that's going to take your blueprint, and I got to make a house out of what you've given me. And this is how I, as the monkey that's going to trade that for you, is thinking about how do I put that on, right? So when I think about a sideways market, I say, how much sideways does it have to be before I can call it sideways? So I'm concerned about how we classify sideways. When I think of sideways, I'm thinking about something that is not directional, meaning it's not breaking out and running, so it has a defined upper and a bottom limit to the channel. Now, how long it's been sideways is the width of that or the length of that channel, right? But the fact that you have a clear support and resistance mark is what characterizes a sideways market. So I always ask, well, how do I know? In one sense, all I really need for a classification of a sideways market is this. Whoops. There we go. I'm trying to get my red arrow working there. Is this little symbol right here? I have some kind of smoothed price marker that shows me there was a clear high and a low, and that yellow box for me is the channel. And as long as it stays in that channel, then this thing is sideways until otherwise noted. I can then say, how much volatility does it have? And what I care about volatility is not whether it's technically quiet, normal, or volatile. All I really want to know about the volatility is, do I have a manageable framework to trade with that volatility? What is the practical, manageable risk box that I can use so that I don't take more than a 1 hour loss? Can I manage 50 cents in my time frame? Or intraday I can manage 50 cents because there's a continuous price signal and there's no gaps because I'm trading liquid indexes or whatever. So 50 cents is manageable. So I know if that's my manageable box, I can now start expressing the expected travel distance between the resistance and the support. I can express that as some multiple of manageable boxes. So I'm just going to show you some concept of 1 to 10. One of the ways that you can quickly find that out is to say, let me find the size of those tradable channels that I want to trade in when I'm sideways. Let me just divide it into tenths, and can I manage 1/10 of the channel as the unit of risk and reward? If I can, that's a good thing, because if I had some kind of indicator that told me, let me see if I can annotate this thing. That would be nice. Yeah. If I had some kind of indicator down here that said price has now moved to the bottom of the channel, and in fact, it didn't break out, it's starting to reverse. Now my job is to figure out how much of that nine potential boxes to the top of my well-defined channel, how much of that am I going to not try to get, and so I can get confirmation, oh, this thing is actually moving in my direction. And now every little degree of certainty that you think that you're getting is simply reducing the amount of the potential reward. So you should pay very close attention to your belief about how much certainty you think you have to have before you feel justified in acting. And here's what I say. When I'm at a boundary I don't care whether this thing is a large channel, a medium channel, or a tall channel, a volatile, sideways volatile channel. If I'm in this bottom region and I get my little one manageable risk box off the bottom, and I have the potential of a 9-to-1 risk to reward, it's never going to get better than that, because I have no reason to believe that it's going to go beyond that. And it's going to stop. I don't know whether it's going to stop here or here or here. All I know is that once it's well started, I have a reasonable expectation of 9-to-1. If I feel like I need to have 2 of those, I still have 4-to-1, right? As long as I can manage the size of this risk, I can now calibrate the expected return to reward to risk ratio. Now, if you find yourself trading multiple signals in this rare condition and you want to get maximum exposure, but you want some diversification, and you had more targets than money, you might want to have some way to prioritize some targets over the others. One way to do that is to simply say, what's my expected reward to risk, given that the channel I've defined is going to be there. So I want you to relax a little bit about all of the technical describing sideways markets and volatility, and what it comes down to, in my view, at the other end, the monkey-proof simplicity is, what's the size of the box that I can manage where I don't take more than a 1-hour loss? It turns out that intraday I can be very small because there's no gap. Overnight, I have to be concerned about carrying overnight risk as part of how much protection I need against noise so that I can achieve the signal protecting against the noise. So whatever time frame you're using this on, and it turned out that you were using daily charts, this same kind of conceptual framework allows you to practically develop a management framework for computing reward to risk rapidly on the basis of a standard amount of risk that you want to take on your symbol. I could just take a look at SPY's ATR or intraday whatever and just say, that's my manageable risk box. Now I can express the size of the channel in terms of the manageable risk box and get my reward to risk very, very nicely in that way. The next thing to think about is, when I am approaching the boundary of my sideways channel, and it's going to behave according to my rules because I study these rules, and therefore the market will listen to me. That's how it works. You tell the market what to do, and then it will do that because it's as obedient as your children. So I want to know, when I'm at these boundary conditions and I'm trading this way, or I'm at the boundary condition trading that way, how volatile is it when it gets near the boundary? Does it get jumpier near here, so I have to have a wider stop? Or does it move out quickly through the channel and then get into a series of tiny little dojis? That's what I want. If that's the case, how I decide how big my box is could be a function of how big the move was coming into the boundary, where I expect the reversal. The next thing I want you to think about is, when you're thinking about those boundary conditions, is this paired, or could it be paired at some point, with a breakout system, so that if I come up in a volatile and I'm in here and I'm ready to trade it this way, the size of this channel might predict the size of the next channel. So if this thing fails but breaks out, I might have found that the failure of this trade was simply information for the next trade. My second most favorite trade in the world, I call the supported spring crossing, which looks like this. It was horrible and starts breaking, and I put a risk box on it, and I want it to work back to the mean. That would be awesome. It's my second favorite trade because when that thing fails immediately, I call that a collapsing dragon, and the size of the box that made it horrible is the size of the next box. So this is a case where if the channel is true, this trade's going to work through the mean and hopefully up to the channel. But if it fails, it's my first favorite most trade. A failed channel reversal is now my favorite trade. So I take this second favorite trade all the time, and I hope it fails. So I find myself in the odd psychological position of wanting to trade my second favorite most pattern and hoping my trade fails, because it leads me to my favorite pattern. I'll tell you, it's not a psychological problem to take that quick 1R loss and stop and reverse because I'm trading up to my favorite pattern. That's a psychological trick that you should consider if your primary trader is a monkey like me. So the larger point is think about how you might pair this system with a breakout. And so what that will let you do is go back to all of your failed signals, see what happens next. What happened after the failure of those patterns? Maybe those small losses are the first increment towards another good system going the other way. So that will keep you occupied for a while. I would take a look at, just in general, if I'm going to use a definition of volatile, normal, or quiet for my channel, I get interested in knowing how long those durations are. Does one follow the other logically, or could I be very, very volatile on this one, and then that leads to some kind of normal one, and it's a real short normal, and then it explodes into... So you want to see somehow how your system of classification is dynamic. How does that... Is it a smooth, orderly progression? It's 3 months, then 3 months, then 3 months, or is this thing flutter? So you want to know that. I talked about the manageable risk box already. The other thing I think about when I'm... Can
I interrupt you 1 second?
Oh, sure.
Because I want to go back to your boxes and your second favorite trade to first favorite trade, and ask a question about how you've seen that over the past, let's say,
3 years
swan dive.
Well, let's just say 3 years.
May of 2020 till now.
How about since March 10th, 2020?
Okay.
When now we're just showing off. When Luke Crockford, who's an accountant in Australia with no trading experience, began trading exactly that system, and now 2.5 years later he traded it for 1 year on one signal or one symbol, and collected 1,500 trades, which were 60% winners, 20% losers, 20% scratch. So 3 to 1. And the payoff was 2.5 to 1. Average win to average loss, and 0 trades losing more than 1R. On the basis of that performance, we tentatively agreed that he may have found a manageable risk box. So then we expanded him from that symbol to a currency pair that traded 24/7, and tried the same thing. And now a year later, he's got 2,700 trades, and the numbers are the same. So we think we're on to something, and no overnight risk. And because it was the Forex on the second one, we weren't worried. Gap was no longer an issue. And by the way, that pattern is fractal, whether you're trading 5 minutes, 60 minutes, or daily bars. That concept. So it's a robust concept. So now what I'm telling you is, as a monkey trader, if you give me a blueprint for how you're setting up very favorable start conditions, what you're giving me with this system as written is, windows of time in which I should pay particular attention to the trading signals and be on my best behavior. Because you've given me a starting point that leads to more favorable trades. So I can now take my standard trade templates and quickly manage it inside the framework of signals that you've given me. Now, one of the things that I do is I trade the same symbols all the time. So the manageable risk box for me in a target is the same box, whether I'm trading pattern 1 or 2 or 5 or a standard, or whether it's always that same kind of box. The size of that box will vary based on volatility, so it's adaptive in that sense. But that's what I want to say about the practical application of a system. What you've done is kind of excluded all the times that it doesn't trade so that you can narrowly attend to those times when it does trade. Under those conditions, you must be very clear on your trade implementation framework so that you execute that perfect setup perfectly. If you're a monkey like me, you can trade a lot of signals approximately. As long as I'm not violating that manageable risk box and not taking losses more than 1R, you will have a freeing feeling in your psychology. And now you can use that, like I said, that box to start framing the size of the trade on the basis of your understanding of the expected move in your market of choice. So the next point, that leads kind of to the next point, if I answered your question on that one. Beware letting the market classification constrain your concept. And that is, you guys spent a lot of time being very clear and precise about what the criteria for go, no-go was. How volatile is volatile, how sideways is sideways. We want to make sure those things are robust. We want to make sure that they persist through time, because you're not going to gather a lot of data on this thing when you trade it forward. So knowing that thing is, those parameters are still valuable and valid, is going to be harder when you have fewer trades going forward. So you have to sort of contend with that. My personal preference is that I would rather trade more often and then adapt to changing market conditions than trying to be very precise and hoping that thing's going to last for 20 years, just in terms of the edge. But that's one of the reasons that you keep designing these systems before you need them, is so that when the old ones go out of phase, you have something that's already ready to go. I think that's about what I wanted to say on this one, except I want to come back to this one about the targets that are more naturally cycling or more naturally sideways. So my experience has been that certain asset classes are more likely to be in these well-defined channels. Now, they could be more or less volatile, but more likely to be in channels than an asymptotic grow to the moon. Now, technology looks like grow to the moon. Biotech looks like it's going to just keep going because it's got unlimited potential. But if you start looking at steel companies or the cost of copper, there are natural limiting constraints on the support and resistance, and that channel is now well defined because professionals are using it to manage their cost for the business cycle. But it turns out when those things break, the follow-through is extraordinary. Like oil went to, well, here, we'll pay you to take oil. Can you imagine we were there less than 2 years ago? Somebody was paying people to take the oil because I didn't have any place to store it. It's so when these well-defined channels break, especially during volatile conditions, don't be surprised if your channel trade doesn't work, but it leads to the reversal. So that's why I really want to encourage you to consider what happened after the failure trades that you had. And there may actually be some gold in that mind as well. And so then what your signal actually is alert me when I'm getting close to the edge of a channel, and now I'm ready to straddle. And the last group with their options magic now start paying attention, because now suddenly you've put them in a critical state that's ready to go in either direction, and now your bracket, whatever you guys do with that magic. So I want you to recognize that all of these systems not only are tradable systems and to get results, but they also carry information content. Their successes and failures and the histogram of their results are giving you information about the market condition itself. And in my view, as primarily a trader, my thought is that the kind of market I'm in is the results that I get. So if I had a system that got good results, then I can backwards refer and say, oh, then the market classification is I'm in the kind of market that this system does well in. At a profound level, the performance of your family of systems is defining precisely the kind of market that it's in. So when these things stop working, don't stop taking the signals. Just chart their performance until they come back into phase, and that system will tell you when it's in the kind of market that that system does well in. There's always room in your house for your children. They can always come home, is what I would say. So in one sense, the effort of this workshop to use market classification first, to then find a system that should work in that market classification, when you go all the way through to the other side of that, like a yin-yang symbol, you then realize that that was just a way to get you to a system that you could study its successes and its failures for the information content of those results. And that's why you want to know those boundary conditions of your system. What happens right near the edge of entry or exits, and what happens next? And so I wanted to say that. Then it turns out that if you have a standard way to trade the signal, then you have simplified the complexity. So I don't have to learn a whole new way to trade with every system. I can actually use some of my standard norms, my little trading templates, my rules of thumb, where I can now start addressing the monkey inside me, which is alert to danger, but which trusts me when I'm following good process like this. I want my inner monkey to be calm, like the monkey behind me. When she senses danger, then I know I need to be on best behavior and make sure all my rules are in place. So I don't want to neglect the application of trading to a good trading blueprint, which I think you guys have. I thought it was very thoughtful, systematic, and complete, and I see a lot of value in the information that you've already discovered, and good places to go to find more, to get more out of that system. Because when that system comes on, you want to stop the presses, assemble the Avengers, and bring money to it. That money's got to be somewhere else working, but this one should take priority when it comes into phase. So that's what I wanted to say about this system. I thought really, really nice presentation.
Thank you.
Yeah, and one right before you jump in, RJ, the reason I was asking that question, Ken, is because we've seen so many different rectangle, band, whatever you want to call, breakouts that then just marched the other way and then came back over the past 2 years, and it hasn't been stopping, and it's been going both ways, unlike anything I've seen since really it didn't work that way at the bottom in 2009 very much, but since all the way back to the .com, that man, it's been a very different market for these types of systems. So yeah, I can see why your student that has been crushing it has gotten those results, because the markets have really systemically changed, I think, in the past year and a half from that perspective.
Yeah, here was an example recently. It happens to be a 3-minute chart. It doesn't matter though. the fact is that if you start thinking of the space between the turning point and those blue lines, that's where the period moving average, it doesn't matter. Pick one. If you mark that off as the channel, that thing is tradable inside the channel. At the yellow dot, you should be paying attention to that. Failure is information. And then the same thing, lather, rinse, and repeat. I could put that on an hourly chart or a daily chart or a weekly chart, and you're going to see exactly the same thing. So what happens at boundary conditions in a channel is of extreme interest. You know, what happened at that? That was at this last yellow dot, it did not fail, or it did not rebound. It failed further. So the information value of your trading system is more than just the results it gets, but the information that it carries about what happens next. So that's what I wanted to say. That was Tesla for about 5R yesterday. $5 risk. When the PSAR flips, I told you about the PSAR, the 2 and the 0.2, 0.12. When the PSAR flips, you get those signals of the green and the red dots. I just follow instructions. I am a monkey. And the yellow box is the size of my standard manageable risk, which is 1/10 of the average range of Tesla over the last 30 days. So I just break the day up into 10. It moves $50 a day from high to low. So I use $5, put a box on it, say, let's go. You can use the same logic on daily charts, but looking back at, 30 weeks and frame it out. So it's a fractal approach to trading the volatile. What I love about this is the volatility of the morning, because of the gap, led to volatile moves in the afternoon, which triggered me that this was high time to be trading Tesla because of the volatility alert. That made it a priority target for me. And then the follow through was not surprising because it was already in a volatile condition. So, over.